the collapse of trust, and the great decoupling. Welcome back. If you are holding tech stocks right now, I have some bad news and some absolutely terrifying news for you. The bad news is this. The giants you once believed were invincible, the ultimate fortresses of Wall Street like Microsoft, Tesla, or Meta, have just seen more than 20% of their value vanish in what feels like the blink of an eye since the start of 2026. Trillions of dollars in paper wealth reduced to ash. But that is not even the terrifying part. The real horror is unfolding in another corner of the market, a corner the mainstream media is deliberately choosing to ignore. In my 20 years in the financial markets, surviving the dot-com crash, the 2008 Lehman disaster, and the global pandemic, I can tell you this. I have rarely seen anything as bizarre, as unsettling, and as deeply alarming as what we witnessed just this past trading week. A full-blown bloodbath for equities on Friday, and at the exact same time, a celebration, a festival for precious metals. Gold surged 2%. Silver didn't just rise, it exploded by 3%. Oil roared higher. All of this happening while nearly every risk asset was in freefall, dropping as if into a bottomless pit. Now ask yourself, do you really think this is just a coincidence? No, don't be naive. The veterans, the old foxes on Wall Street, they do not move randomly. Capital at that level does not panic without purpose. What you are witnessing is a signal. A loud, unmistakable signal of something far bigger beneath the surface. This is what seasoned financial insiders call the decoupling. Let me speak to you now, in the only language that truly matters in this market, the language of capital flows. Take a step back and look at the global market cap structure. In just 7 days, one short, seemingly insignificant week, the weight of gold and silver among the top 10 largest assets on this planet quietly climbed from 62% to 63%. 1%. It sounds small, almost irrelevant, right? Absolutely not. That single percentage point represents a migration of hundreds of billions of dollars. This is not noise. This is not random fluctuation. This is a subterranean earthquake moving beneath your feet, silent but powerful enough to reshape the entire financial landscape. What you are witnessing is smart money making its move. Cold, calculated, silent. They are pulling the plug on paper assets. They are stepping away from the illusion of future earnings, from valuations built on promises and projections. And instead, they are moving into something tangible, something real, something that does not depend on trust. Gold, silver, physical, immutable, final. Now here's the question you need to ask yourself. Why does this decoupling matter so much? Why could it determine whether your portfolio survives or gets wiped out? Because historically, in times of panic, everything gets sold. Everything. Investors dump stocks, bonds, even gold. They liquidate whatever they can to raise cash, to cover margin calls, to stop the bleeding. Gold in those moments becomes nothing more than a blood bag for the broader market. But not this time. Something has changed. Gold is no longer playing that role. It is no longer sacrificing itself to stabilize a collapsing system. Instead, it is walking its own path, the path of an emperor. Unaffected, untouchable, detached. No matter how hard the Nasdaq falls. No matter how many reassuring words come out of central banks, gold and silver are sending a message. A cold, ruthless, undeniable message. Trust in the fiat system is collapsing. Unmasking the time bomb in private credit. My friends, the true catalyst behind this great escape is not found in the green and red candlestick charts you stare at every single day. It is not on your trading screen. It is not in the headlines. It is buried deep in the shadows, inside something most retail investors barely understand, the private credit market. This is where the dirtiest secrets of the modern financial system are being hidden. Now listen carefully, because what I am about to say, you will not hear on your morning financial news. The most powerful asset manager on this planet, BlackRock, has already started restricting withdrawals from its credit funds. Think about that for a moment. When the biggest player in the game quietly limits your ability to take money out, that is not a routine adjustment. That is a warning. And then it didn't stop there. Morgan Stanley, another giant, another pillar of global finance, followed with similar moves. Quietly, strategically, locking the doors just enough to slow the outflow. But the real shock, the moment that should send a chill down your spine, came from UBS, Switzerland's grand bank, a symbol of stability, of discretion, of control. They issued a notice, cold, clinical, but absolutely devastating. They are halting withdrawals from a massive real estate fund for up to 3 years. 3 years. Let that sink in. This is no longer about volatility. This is no longer about market cycles. When institutions begin restricting access to capital, when liquidity starts to vanish behind closed doors, you are no longer in a normal market. You are standing right in front of a ticking time bomb. Do you understand the implications of this? Imagine for a moment, you are inside a burning theater. Smoke is filling the air. People are starting to panic, and instinct kicks in. You run toward the emergency exit. But when you get there, you find it padlocked, not jammed, not broken, locked from the outside. That is exactly what is happening right now to the capital of major institutional players. They entrusted their money to these funds, believing in liquidity, believing in safety, believing they could exit when needed. And now the funds are telling them, calmly, coldly, your money is trapped in bad debt. Come back in 3 years. 3 years in a crisis. When the exit door for cash is locked, panic is not a possibility. It is inevitable. Billion-dollar institutions are waking up to a brutal truth. Those complex credit derivatives, those polished fund certificates, all the structured products designed to look sophisticated and secure, in a real liquidity crisis, they collapse into something far more primitive. Worthless. Just paper. They are realizing, too late, that they do not truly control their own assets. And when that realization spreads, it doesn't just shake portfolios. It shatters the very foundation of trust that the entire debt-based system is built upon. Now, let's rewind for a second. Back to 2023. When a handful of regional banks in the United States collapsed, the system only felt a tremor, a warning shot. But even then, the reaction beneath the surface was telling. Gold surged 9%. Silver exploded 20% in just 8 weeks. And back then, the Federal Reserve still had room to act. It could step in, print money, stabilize the system, restore confidence, at least on the surface. But now, this is 2026. The scale of toxic debt, especially in commercial real estate and private credit, has swollen to a level that is far more dangerous, far more systemic. We are no longer dealing with isolated failures. We are staring at a network of fragility, deeply interconnected and highly leveraged. And here is the uncomfortable truth. Even the Fed's money printer is starting to look powerless. Because when counterparty risk reaches its extreme, when the risk that the person or institution holding your money might fail becomes undeniable, capital begins to move in only one direction, toward assets that require no trust, no promises, no counterparties. A gold bar in your hand does not depend on the words of a central banker. It does not rely on a balance sheet. It does not ask for permission to be withdrawn. It simply is. It is real money. And right now, the smartest, most informed players in the world, the elite, are moving quietly, urgently, almost desperately to accumulate it. Because they understand something the masses have not yet fully grasped. When the realization finally spreads, when the crowd begins to see what is already happening beneath the surface, it will already be too late. The ultimate rocket fuel, negative real rates. A lot of people out there, even those who call themselves analysts on television, keep repeating the same warning. Don't buy gold. The Fed is keeping rates high. Gold yields nothing. And every time I hear that, I know immediately who I'm listening to. Not someone who understands the system, but someone who memorized a textbook and stopped thinking. Because the truth is this: the price of gold has never been dictated by nominal interest rates. Never. It is dictated by real interest rates. The formula is simple, but its impact is enormous. Real rate equals the nominal rate you receive minus the rate of inflation. That's it. That single equation has been the hidden engine behind every major bull run in hard assets throughout history. Now let me take you back to a moment that should completely shatter the conventional narrative. The year is 1974. America is in the middle of a brutal oil crisis. Energy prices are exploding. Inflation is spiraling out of control. And the Federal Reserve responds the only way it knows how, with force. They raise interest rates aggressively, all the way up to 13%. 13%. According to everything you've been taught, that should have crushed gold. High rates mean stronger currency, higher yields, less incentive to hold a non-yielding asset like gold. That's the theory. But reality told a completely different story. Because at the same time, crude oil surged 159%. Inflation didn't just rise, it detonated. It blew past every attempt by the central bank to contain it. And when you subtract that level of inflation from the nominal rate, the real interest rate didn't rise. It collapsed deep into negative territory, negative 2.9%. And in that environment, gold didn't fall. It surged because once again, the market was not reacting to what the Fed said. It was reacting to what people actually felt in their wallets, the silent erosion of purchasing power, the realization that even high interest rates were not enough to outrun inflation. That is the moment when capital shifts. That is when gold stops being an option and becomes a necessity. What happened to gold? Instead of collapsing, gold launched. It didn't hesitate. It didn't wait for confirmation. It surged 66%. Silver followed with a powerful move of its own, rising 33%. All of this happening inside an environment where interest rates were sitting at 13%. Think about that. Everything you've been told says that should be impossible. But the market doesn't care about theories. It responds to reality. And the brutal, blood-soaked lesson from that moment is simple. Gold does not care how high the Fed raises rates. Gold only cares about one thing: how fast paper money is losing its purchasing power. Now, welcome to 2026. History may not repeat itself exactly, but it always rhymes. Inflation today is not a temporary spike. It is embedded deep within the system. Supply chains remain fractured. Energy costs continue to climb. And the official numbers, the CPI, are already threatening to push beyond 3.4% and possibly much higher. But here's the part most people still don't fully grasp. Even if you do what you were told was safe, even if you park your money in a savings account, the interest you earn will never be enough to recover what inflation is quietly taking from you. You are not preserving wealth. You are slowly, mathematically, losing it. And the longer you hold paper money under these conditions, the outcome becomes certain. You become poorer, not by accident, but by design of the system itself. Now imagine when the largest financial institutions in the world fully internalize this reality. They don't have the luxury of ignoring it. They don't have the option to sit still. When they see a systemic liquidity crisis forming, when they recognize that real rates are firmly negative, they are forced into action. Because that combination, a liquidity crisis on one side and negative real rates on the other, is not just dangerous. It is corrosive. It is the kind of force that dissolves the value of fiat currencies from the inside out. And at the same time, it becomes the ultimate jet fuel. Fuel that doesn't just lift precious metals, but propels them violently, relentlessly, into the stratosphere. The timeline and the unthinkable endgame. Now let's get grounded. No more theory, no more abstract warnings. The question becomes simple. What do you actually do to avoid being left behind in what could become one of the largest wealth transfers of our lifetime? Because understand this clearly. In a market like this, it's not just about being right. It's about surviving long enough to be right. And to do that, you need a roadmap. You need clarity, especially when the market starts shaking, when volatility spikes, when short-term moves are designed specifically to scare you out of your position. This is where most people fail. They don't lose because they chose the wrong asset. They lose because they couldn't hold through the noise. Now, let's talk about the levels that matter. The levels that the biggest pools of capital on this planet are watching with absolute precision. For gold, everything revolves around one number, $4,600 per ounce. That is not just a price target. That is a trigger. The moment we see a weekly candle close firmly above that level, not a spike, not an intraday move, but a confirmed close, that is the starting gun. That is when hesitation disappears. That is when capital stops testing and starts chasing. And when that happens, the move that follows is not gradual. It is explosive, full acceleration. The kind of move that leaves latecomers staring at charts in disbelief. The window for that ignition is expected between May and July of this year. Now, silver. Silver is a different beast entirely, more volatile, more emotional, often ignored, until it suddenly isn't. Its critical level stands at $71 per ounce, and historically silver always lags behind gold. It waits, it builds pressure, it lets gold lead the narrative. But when it moves, it doesn't walk. It sprints, violently, unpredictably, the kind of move that can make even experienced investors uncomfortable. Its ignition phase is likely to arrive later, around the third to fourth quarter. Think September into October. And then there's the overlooked engine behind all of this, the mining stocks. These are not just passive reflections of gold prices, they are leverage machines. When gold rises, their margins expand exponentially. Costs remain relatively stable, but revenue surges, and that expansion shows up in their earnings, which is why the upcoming Q2 and Q3 earnings reports are not just routine updates. They are potential catalysts, triggers that can set off a chain reaction across the entire sector. This is how phases unfold. First, the smart money accumulates quietly. Then, the breakout confirms the trend. Then, the acceleration pulls in momentum. And finally, the public arrives. But by then, the real move has already happened. And now, the million-dollar question. How far can this really go? I'm not here to throw out fantasy numbers or feed you hype. What I'm about to say is grounded in historical cycles, patterns that have already played out more than once. Let's go back to 1973. After a temporary dip, gold surged 107%. Silver didn't just follow, it exploded 173%. Then we moved to 2008. Gold climbed 168%, and silver created a financial earthquake, surging 467%. These are not anomalies, these are cycles. Now take that same mathematical behavior and apply it to today's environment. A world drowning in debt. A system far larger, far more leveraged, far more fragile than anything we saw in the past. Suddenly, targets like $7,000 per ounce for gold and $200 per ounce for silver, they stop sounding insane. They start sounding logical. Because here is the structural truth most people miss. The precious metals market is tiny, minuscule, compared to the massive oceans of capital sitting in equities and bonds. And when that elephant decides to move and tries to squeeze into a space that's small, that narrow, the result is not gradual appreciation. It is vertical expansion, violent repricing. Now, here is the most dangerous trap in this entire environment. The mindset that is quietly destroying portfolios every single day. Wait for the bottom. People sitting on cash, waiting for gold to drop back to 3,000, waiting for silver to fall to 50, convincing themselves they're being patient, that they're being smart. But listen carefully. In a supercycle, there is no clean second chance. Once the train leaves the station, it does not come back. It accelerates, and those who hesitate get left behind. That is why the largest funds in the world are not trying to time the perfect entry. They are executing a completely different strategy. Dollar cost averaging. Consistent, disciplined, relentless. They use every short-term dip, every shakeout, every wave of fear pushed by the media as an opportunity. Not to panic, but to accumulate. To increase their exposure to real physical assets, piece by piece, before the window closes. Because in a market like this, it's not about catching the bottom. It's about not missing the move. The financial game of 2026 is no longer about making a few dollars from day trading. That era is over. What we are stepping into now is a game of survival. A system that once looked stable, predictable, even permanent, is beginning to fracture at its core. And when that kind of structural shift happens, it doesn't reward speed, it rewards positioning. So the question you must ask yourself is no longer, how much can I make? The real question is, how do I protect what I have and grow it in a system that is actively eroding value? Because whether you realize it or not, a silent transfer of wealth is already underway. On one side, those who hold assets tied to a system built on debt, promises, and paper. On the other, those who position themselves in assets that exist outside of that system, assets that do not rely on trust, assets that cannot be diluted, frozen, or inflated away. And eventually, one side wins. So now, the decision is yours. Will you remain exposed, slowly losing purchasing power year after year, becoming a victim of inflation that never announces itself loudly, but always takes more than it gives? Or will you step into alignment with the shift and position yourself to emerge not just protected, but ahead, as one of the few who understood what was happening early enough to act? Take a moment and ask yourself honestly, right now, what percentage of your portfolio is truly in real assets like gold and silver? Are you still betting on a rebound in tech stocks, believing this is just another temporary correction? Or are you starting to see that this could be the early stage of something much deeper, something structural, something that doesn't reverse overnight? I want you to think about that. And if this perspective has opened your eyes, even just a little, if it has given you a new way to see the market, a new tool to protect not just your wealth, but your future, then stay close to this conversation. Because in times like these, clarity is not just power, it is survival. Keep your head cool, stay disciplined, and we'll continue this journey all the way to the point where preparation meets opportunity.